Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to do a summary module of credit management, specially focused on ratio analysis. Now, this is going to be a very comprehensive video with a lot of MCQs and information related to the exam. So, if you like this video, you can press the like button, subscribe to our channel, and share it on social media. Help us to spread education in this beautiful world. Now you can also get a copy of this in a PDF format from the link which I have put in the description below. This will be very helpful for quick revision. Now let's start the video. Financial statements generally consist of the following two types: profit and loss account, which summarizes the expenses incurred and the revenues received during the period covered by it. Balance sheet is something which lists out the assets and properties owned by the unit and liabilities it owes to the outsider and also to its owners. Now, who are interested in financial statements? The management of the company, because they want to know the financial statement of the concern, how far the targets of production, sales, and profits have been achieved, to determine the tax liabilities, what is the amount available for dividends, bonus payment, planning and future activities of the concern. So other people who may be interested in financial statement is creditors, bankers, financial institutions, general financial position to determine if the concern is worth lending to, whether the sales, production, profitability and increase are increasing or decreasing, the liquidity position of the concern, that is whether they are meeting the liabilities in time, the assets that are available to secure their advances, the stake of the owners of the concern as compared to the amount lent, how the amount lent to the concern has been utilized, and so on. Now, major components of profit and loss statement is net sales. This is the key figure in the income statement which can be arrived from the following. Net sales is equal to gross sales minus excise duty. Now, gross sale is equal to the total domestic sales plus export sales minus sales tax, octroi or sales return. So it's a very common sense formula which you can definitely apply if you get a numerical. So net sales is gross sales minus excise duty. In gross sale is total domestic sales plus export sales minus all the taxes which you have to pay. Okay. Now cost of production. Now it is the sum of cost of raw material consumed in all manufacturing expenses. So if you have to calculate cost of production, it is the cost of raw material plus manufacturing expenses. Now, manufacturing expenses include spares, power and fuel, wages and salary, other manufacturing expenses, depreciation, difference between opening and closing stock. Cost of sale, it is the sum of cost of production and difference between opening and closing stock of finished goods. Gross profit is net sales minus cost of sales. So whatever sales has happened, you reduce the cost of manufacturing, the cost of sales. So the percentage of gross profit to net sales indicates whether the average sale price is sufficient to cover all the expenses. So if you take out gross profit divided by net sales, it will give you a very good picture. Now operating expenses. Now these are the expenses which are required to run the business on daily basis, such as selling expenses, administrative expenses, general expenses, provision for bad debts, other miscellaneous expenses. Now, operating profit, when you deduct all the operating expenses from the gross profit, you arrive at the operating profit. Now, operating profit is gross profit minus all operating expenses. Now, finally, to this operating profit, other incomes not arising from normal operations are added and other non-operating expenses are deducted to arrive at the figure of net profit before tax. Now, the balance amount is reinvested in business in the form of reserves or added to the capital account. Now, balance sheet is a statement of assets and liabilities which we all know, and it is as on a given date. So, whenever you see a balance sheet, it will be as on 31st of March 2019 or 18. So, that balance sheet will indicate the position of the company on that particular date. It reflects the financial position of a concern as on date. The balance sheet can be looked from two angles: assets, which are the uses, and liabilities are the source of fund. So anything which is coming in the company are the sources of fund, and anything which is being used are the assets. So assets as what the business owns, and liabilities is what the business owes. So if you talk about liabilities, the major components which consist liabilities is net worth, term liability, and current liability. In assets, fixed assets, current assets, and other non-current assets. Now let's talk about net worth. Now it is the total investment of the owners in the business. For a limited company, it comprises of a sum of share capital plus reserves. Now share capital is the direct investment of the owners in the business. This includes equity share capital and preference share capital. Reserves, profit of the business which have been reinvested in the business. In proprietorship and partnership firm, they are added to capital and not shown separately. Term liabilities, all those borrowings made by the concern which are repayable after 1 year of the balance sheet date are called term liabilities. Term liabilities are majorly the long-term loans which the companies take, which are maturing after 1 year. So term loans, debentures, term deposit, redeemable preference share capital. Now current liabilities are all those borrowings made by the company which are expected to be repaid within 12 months from the date of the balance sheet. This includes creditors, provision for expenses, bank borrowings for working capital, deposit maturing within 12 months, installment of term loans, debentures, redeemable preference share maturing within 1 year. So total of term liabilities plus current liabilities is called outside liabilities and is the total borrowing of the firm. So if you have to calculate the total borrowing, what you will add? You will add total long-term liabilities plus current liabilities. Okay. Now let's talk about fixed assets. These are the assets which help in the production of goods and services of the concern. They are tangible in nature and can have long life. The example of fixed assets are land, building, plant and machinery, furniture, and etc. Current assets. Now these are the assets which are expected to be consumed or converted into cash through normal business operations and usually within 1 year, such as cash and bank balances, fixed deposit with banks, short-term government securities, stock of semi-furnished and furnished, stores, spares, advances, payments for suppliers, prepaid instruments, debtors and bills receivables. Non-current assets, these are the assets which do not fall in the above two categories of assets. These are corporate investment, loans not recoverable within 1 year, non-consumable spares, deferred receivables, advance for capital expenditure, intangible assets, goodwill, patent, trademark, preliminary and pre-operative expenses. Now, financial statements are studied to know does the firm has liquidity to meet its short-term obligation? Would the firm be able to meet its long-term commitments? Is the firm using its assets efficiently? How profitable are the operations of the firm? So lenders need to carry out technical appraisal, commercial, financial, economic and management appraisal to understand these objectives. So what is financial analysis? Now it is the process of identifying the financial strength and weakness of a firm by properly establishing relationship between the Items of balance sheet and profit and loss account. So this is done by the firm's management, owners, creditors, investors, bankers, and others. Now, why financial analysis? Trade creditors, they do it to know the firm's ability to meet their claim. So for trade creditors, it is all about liquidity. For suppliers of long-term debt, they need to know the firm's long-term solvency. So it is the profitability over a long period of time. Investors, they are concerned about the firm's earnings. Bankers, they need to understand the soundness of business so as to take a good credit decision. Now, ratio analysis is a tool which enables the banker or the lender to arrive at the following: liquidity position, profitability, solvency, financial stability, quality of management, safety and security of loans and advances to be already been provided. Now, ratio is indicated quotient of two mathematical expression, that is relationship between two or more things. Ratio analysis involves comparison of useful interpretation of the financial statement. A single ratio does not indicate favorable or unfavorable condition. It should be compared with some sort of standard. Standard of comparison may consist of ratios calculated from the past financial statement of the same firm, ratios developed using the projected financial statement of the same firm, ratios of some selected firms, especially the most progressive and successful at the same point of time, ratios of the industry level to which the firms belong. So how a ratio is expressed, we all know as percentage, as proportion, as pure numbers. So this is the format of balance sheet, liabilities and assets. You can pause the video and look at all the components. Classification of ratio, balance sheet ratio, profit and loss ratio, balance sheet and profit and loss ratio. So financial ratio, operating ratio and composite ratio. Okay. Now liabilities have credit balance and assets have debit balance. Current liabilities are those which have either become due for the payment or shall fall due for the payment within 12 months from the date of balance sheet. Current assets are those which undergo change in their shape, form within 12 months. These are also called working capital or gross working capital. Net worth and long-term liabilities are also called long-term sources of fund. Current liabilities are known as short-term sources of fund. Long-term liabilities and short-term liabilities are also called outside liabilities. Current assets are short-term uses of funds. So assets and current assets are long-term uses of fund. Installment of term loan payable in 12 months are to be taken as current liability only for the calculation of current ratio and quick ratio. Now, if there is a profit, it shall become a part of net worth under the head reserve, and if there is a loss, it will become a part of intangible asset. Now, investment in government securities is to be treated current only if these are marketable and due. Investment in other securities are to be treated current if they are quoted. Investment in allied associate sister units or firms to be treated as non-current. Bonus shares as issued by capitalization of general reserve and as such do not affect the net worth. But with right issues, change take place in the net worth and current ratio. Now, current ratio, it is the relationship between current assets and current liabilities of a concern. You can take this example. So the ideal current ratio preferred by bank is 1.33 is to 1. Current assets, cash are those assets which can be converted into cash within 1 year. Okay. Current liabilities. Now current ratio measures the firm's short-term solvency. A ratio greater than 1 means that the firm has more current assets than current claims against them. Okay. Net working capital, this is worked out as a surplus of long-term sources of long-term uses. So alternatively, it is the difference of current assets and current liabilities. It measures the firm's potential reservoir of funds. So if you have to calculate net working capital, you just subtract current assets minus current liabilities. Asset test or quick asset ratio. It is a ratio between quick current assets and current liabilities. So, quick current assets are those which can be immediately converted into cash without a loss of value. Cash and bank balances are the most liquid assets. Examples of quick assets are cash bank balance, receivables up to 6 months, quickly realizable securities such as government security or quickly marketable quoted shares in bank fixed deposit. Inventories are less liquid, hence the same is deducted from current assets to arrive at quick assets. So asset test or quick ratio is quick current assets divided by current liabilities. Okay. Debt equity ratio, it is the relationship between the borrower's fund and the owner's capital. It represents the lender's contribution for each rupee of owner's contribution. So long-term outside liability divided by tangible net worth. So debt equity ratio will be debt divided by equity. So debt is 800 and equity is capital plus free reserve 500. So 800 divided by 500 is 1.6 is to 1. Okay. Propriety ratio. Now this ratio indicates the extent to which tangible assets are financed by owner's fund. Propriety ratio is tangible net worth divided by total tangible assets. The ratio will be 100% when there is no borrowing or purchasing of assets. Gross profit ratio, by comparing gross profit percentage to net sales, we can arrive at gross profit ratio, which indicates the manufacturing efficiency as well as the pricing policy of the concern. Okay. Operating profit ratio, it is expressed as operating profit divided by net sales into 100. So higher the ratio indicates operational efficiency. Net profit ratio is net profit divided by net sales into 100. It measures overall profitability. So operating profit ratio, operating profit by net sales, net profit ratio, net profit by net sales. Stock inventory turnover ratio, now it indicates the efficiency of firm in selling its product. It is calculated by dividing the cost of goods sold by average inventory. To arrive at the number of days, weeks or months turnover, the following formulas may be applied. Okay. So average inventory of stock is opening stock plus closing stock divided by 2. Now this ratio indicates the number of times the inventory is rotated during the relevant accounting period. That is how rapidly the inventory is turning into receivables through sales. Generally, a high inventory turnover is indicative of good inventory management and vice versa. Debtors turnover ratio, it is also called debtors velocity or average collection period or period of credit. So average debtors divided by sales into 365 for days. Asset turnover ratio, net sales divided by tangible assets. Fixed assets turnover ratio, net sales divided by fixed asset. Current asset turnover ratio, net sales divided by current assets. Creditors turnover ratio, it is also called creditors velocity ratio. It determines the creditor's payment period. So average creditors divided by purchases into 365 days. Okay. Return on asset, net profit after tax divided by total assets. Return on capital employed, net profit before tax and interest divided by average capital employed into 100. Average capital employed is the average of the equity share capital and long-term funds provided by the owners and the creditors of the firm at the beginning and at the end of the accounting period. Composite ratio, return on equity capital, net profit after tax divided by tangible net worth. Earning per share indicates the quantum of net profit of the year that would be ranking for dividend for each share of the company being held by equity shareholders. Net profit after taxes and preference dividend divided by number of equity shares. Price earning ratio indicates the number of times the earning per share is covered by its market price. Market price per equity share divided by earning per share. Now, debt service coverage ratio, the ratio is one of the most important one, which indicates the ability of an enterprise to meet its liability by way of payment of installments of term loans and interest thereon from out of the cash accruals and from the basis of the fixation of repayment schedule in respect of term loans. So the ideal DSCR ratio is considered to be 2. So profit after tax plus depreciation plus annual interest on long-term loans and liabilities divided by annual interest on long-term loans and liabilities plus annual installment payments on long-term debts. So where profit after tax and depreciation, okay? So this is a very important slide which gives you the entire formula of all the ratios. So it's a good way to write it down on a piece of paper and make sure that you learn all these formulas, because you will definitely get a good amount of questions from this PPT page. So these are some of the exercises. What is net worth? Capital plus reserve, 180 plus 20, 200. Okay. Tangible net worth is net worth minus goodwill. We have calculated net worth is 200. Now we'll subtract goodwill, 50. So 200 minus 50 is 150. Outside liabilities, term loan plus cash credit plus creditors plus provisions. 300, 200, 500, 600. 600 is the answer. So if you know the formulas, you can do the calculation orally as well. So net worth capital plus reserve 200. Tangible net worth is net worth minus goodwill 150. Outside liabilities is term loan plus cash credit plus creditors plus provisions. Net working capital, current assets minus current liabilities. So current liabilities we'll have to calculate, and current assets. Current liabilities would include 200 plus 50 plus, first we'll calculate current assets. Let us calculate current assets. So inventories will form the part of current assets, cash will form the current assets 200, and receivables 350. So 350 is current assets. Let's calculate current liabilities. Current liabilities will include 200 plus 50, 250. So 350 minus 250, it should be 100. Current ratio, current assets upon current liabilities. So current assets we have calculated 350 divided by 300. So this 250 is wrong. It should be 250 plus 50. Provisions will also be part of liability. Okay. Quick ratio is equal to quick assets minus uh, current liabilities. In quick assets, you have to subtract current assets minus inventory. So we have taken out current assets 350, inventory is 150. So 350 minus 150 is 200 divided by CL. Can do the second exercise. Tangible net worth for first year, current ratio for second year, debt equity ratio for first year. This is exercise number 3. Exercise number 4. Debt equity ratio is long-term loan divided by tangible net worth. Long-term loan is 100. Okay. Tangible net worth is 362 minus 30. Okay. This is something which you can definitely look into. What is propriety ratio? What is the net working capital? Another exercise. Net profit ratio, net profit divided by sales into 100. Another example, another exercise, question number 8, question number 9, question number 10, question number 11, 12. You can pause the video and can answer these questions in the description box below. This is very important PPT. If you go through it, you will be able to answer all the questions. So if you have reached at the end of this video, be rest assured that you have reached a channel that will give you a similar treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner. And you can also download the PDF copy of this PPT from the link I have mentioned in the description box below. Thank you.